Will anyone please help me in providing whether am I audible? Okay, thank you so much. So hello and good evening and good morning to everyone out here. And today we'll be taking up just a small walkthrough with the fixed assets management in the Oracle NetSuite application. So let's start. So fixed assets are the long-term tangible piece of property or equipments that a firm owns into a firm actually owns and uses it in its operations so that they can generate income with the help of that particular asset. Now, fixed assets provide a long-term financial gain and has a useful life of more than a year and is classified as a property, plant, and equipment on the balance sheet, or maybe you can have it as land, or there are various fixed assets that there are machinery that there are into an organization. So fixed assets are not expected to be consumed or converted into a cash within a year. So fixed assets commonly appear under the balance sheet as fixed assets. Then they get a net balance by deducting the accumulated depreciation of into the asset, and this is how the assets are basically presented into the balance sheet. Then apart from being used to help a business generate the revenue, they are also actually closely looked upon by the investors. Now investors that are by the investors, you can say, let's say if I'm an organization, I've been working, I've got certain projects, so I may require certain debt, or in the form of any loans, or in the form of any kind of debt from any of my financial institutions, from any international financial institution, or a kind of investor. So anyone from whom, or any person who is also investing into the company, maybe in the point in the form of shares also. So if any investor or any financial institution who is going to either invest in the company, or maybe who is going to lend to the company, fixed assets are one part that are closely looked and monitored and calculated by the investors or by the lending authorities when they decide whether or not to invest in the company, or whether or not to provide you with the required amount of debt or not. And if provide you with a debt, usually what happens is you mortgage the fixed assets. Certain fixed assets are mortgaged, and then you are actually receiving the debt from your financial institutions or any investor if they are providing you in the form of collateral. You keep the fixed assets with them, and then they provide you with the required amount. So this is what how the fixed assets actually play a very important role into the organization. Now, once we have seen that these are the uses of the fixed assets, of course, fixed assets do not stand onto my organization at the same amount or at the same cost that they were purchased at. Along with time, with the pace of time, along with the usage, there are wear and tears into the fixed assets, or into an asset due to the long wear and tear, due to the long usage maybe, or with the pace of time, since we are going to since you're moving forward in a digitalizing world, or maybe into a world where there are so many changes taking place. So any kind of asset depreciates. Now depreciation is basically when the cost of the asset is reduced due to the wear and tear, or maybe because a new technology has come up and the existing asset is not fulfilling the task as it should be, or as it might have been when it was purchased. So this is a point of depreciation also that is attached to the assets. So these are most of the terms which are into the fixed assets. I mean, this is the fixed assets, how they are useful into the organization, and whether it depreciates or not. And this is the whole scenario of my fixed assets. So yes, now coming on to the life cycle of the fixed assets. Now, as you can see, the whole life cycle of the asset starts when the asset is acquired by the organization. Any asset, when is acquired by the organization, the first step is either you purchase it directly from a supplier, or maybe by a any purchaser, or you've just bought the fixed asset. The other way is you can also lease out the asset. So these are the two ways where a transaction takes place at the time of acquisition. Either you purchase the asset or you take it on lease. So either it will be a lease transaction, you'll have a lease contract, lease payment, leased the payments will be paid out every month or every year, depending on the whatever contract that you have with the leaser and the leasee, whatever the contract there is between them. Or you're going to either purchase it. So this is the transactions that are at the time of acquisition, that happen at the time of acquisition. The next part is, now as with the usage of time, in the pace of time, as and when the assets are used, the next transaction that happens into the fixed assets life cycle is the depreciation that is taking place. That is due to the wear and tear. The cost of the asset is reduced with small amounts. Now the depreciation can be, there are various methods of depreciating an asset. You can use an SLM, that is straight line method. You can have declining balance method. You can have sum of years digit method. There are various methods, to a unit of production method. There are various methods with the help of which you actually depreciate the asset. Now when you depreciate the asset, there's a transaction that happens. Depreciation depends, you can have a monthly depreciation also, or you can have an annual depreciation of the asset. So this is another the second transaction into the life cycle of the asset. Next comes an era, or next comes a point of time into the asset life cycle, where the assets value into the market. Revaluation is basically, into simpler words, if I put it into a layman language for us to understand, revaluation is basically, you keep on there are times when you keep on checking the value of your asset. Let's say if I have a cell phone, today the value of that cell phone might be $20,000. But as and when into the next coming years, though I'm not thinking of selling it, but let's say I would like to know the value of my cell phone in the 2 years have passed, and I would like to know the value of my cell phone as per the depreciation cost or something. I suppose that 10% was the amount that was to be depreciated. So that means 2000 per year. 2 years have passed. $20,000 was the amount of the cost of my cell phone. 2 years have passed. 4 years, $4,000 is the depreciation that has been charged. So as per me, the amount for my cell phone is $16,000. But when I got to the market and I researched, I suppose that if in today's market I go and sell my cell phone, I will get only $12,000. So that means the value of my cell phone has actually degraded, maybe due to any technology. Maybe the technology has been obsolete. There are new softwares that are coming due to any reason. So I am going to revalue my cell phone. So I will be revaluing my cell phone. So in today's date, the cell phone value into the market is 12,000. So I am going to value it into my books also at 12,000. And then after that, I'm going to depreciate, that is 10% per sorry what the 10% per year. I'm going to depreciate it on the 12,000 amount, and not the 16,000 that I supposed I should have into as per my books. So this is a revaluation, which is also a third type of transaction which happens into the life cycle of a fixed asset. Next comes is the impairment. Now the impairment means, again, that we have taken the example of the cell phone. Now let's say there is a new technology, there has been a new software that is introduced into the cell phone market, a new kind of app, which my cell phone unfortunately will not support it because of the version of the iOS, or maybe of the Android or Windows, whichever version it is running on, it is not supporting that application. That application is into the demand into current markets. So basically my particular asset has been impaired. So that means now revaluation and impairment are two different things. Revaluation is my asset is still in use, it will be in use, but the value has decreased. Impairment is I've actually occurred a loss, because now that application will not be, I'll not be able to install it on my iPhone or maybe Android, or where there are various kinds of versions into cell phones. So I'll not be able to download it. So that is impairment. I mean, uh, I have actually suffered a loss. There is an impaired asset into my books. So that is another kind of a transaction that happens into the life cycle of the asset. Now I'm using the cell phone example because this is everyone will be able to connect it to this. I'm not using a proper fixed asset, maybe a land or a building example. This is the reason I'm using a cell phone example. And then the last part is I've had a depreciation attached to the asset. I've had a revaluation on the asset. I've had an impairment loss I've incurred into the asset life. The next is now the asset has been depreciated, revalued, and impaired. The last is now I'm going to dispose of the asset, because of course every asset has a useful life. Useful life as in, let's say a property, plant and equipment, or a research equipment has a useful life, as per the statutory authorities across the world, maybe 8 years. At some places it is 7 years, at some places it is 9 years. This is based on the statutory authorities records in some of the organization. Property, plant and equipments, you can have a disposal life or a useful life of 7 years maybe. So this is there is a useful life that is attached to the asset. The assets cannot be used for the lifetime of the organization. There is a end to the life of the asset also, after which it is not any useful, it is not helping you generate any revenue. The only thing it is doing is uh, it is only leading you back, it is keeping you back from the generating certain extra revenue that you could by the use of a new asset. So in the last part, or the stage of my life cycle of an asset is I'm going to dispose of the asset. So the disposal of the asset is, you can either sell off the asset in the market if it has got certain value. If you're able to get certain good value for the asset, you can either sell it into the market, or you're just going to dispose of the asset. That means you've just disposed it off. You haven't sold it, you haven't had anything, you've just disposed of the asset. You're not using it any longer. Let's say it is a part of a machinery or something, you've just kept it at a place, and you have scraped it off maybe. You've just disposed it, you haven't sold it into the market so that you can actually get certain money. You've just disposed it off, you're not using it anymore. It's just lying as a certain item in your factory, or at your office, or whatever is your organization place of working. So it is just kept there. You haven't sold it, you are not using it, it has been disposed of. So this is how the life cycle of an asset actually works into most of the, I mean, all the fixed assets have this kind of a life cycle, where it starts from acquisition, then you depreciate it, you revalue it, you suffer an impairment loss, and then you just dispose it off. So this is how the life cycle of the asset actually works. Now, since we have seen what is the life cycle of the asset, uh, all the transactions that there are, that has happened into the whole life cycle of the asset, have an impact of the financial statement. We, in the last part, we have seen the transactions that may happen into with the fixed assets, and this is how are these transactions going to impact on the financial statement. Starting from the acquisition, I'm just taking an overview. Starting from the acquisition, the first time when I acquire the asset, it will form a part of my balance sheet. So whatever is the cost, let's say the cost of my asset is $20,000 or $1 lakh. So I am going to record it into my balance sheet. It will form a part of my balance sheet as in fixed assets. Um, IT equipments I've purchased. I have purchased an IT equipment. So IT equipment under the fixed asset amount is $1 lakh. I'll be putting it into my balance sheet. Now into uh, the next part is for the first year, or for the coming years, let's say the life cycle or the life of the asset is 9 years, $10,000 is the salvage value of my asset. So every year the asset is going to depreciate. So that depreciation that will be charged every year, it is going to form a part of my income statement or my profit and loss statement, if you want to put it in another way. The depreciation will find its way to the income statement or the profit and loss. Then you have then we'll be taking up the revaluation and the impairment also. And then comes, there are three vital statements of any organizations, any mid-size, small enterprise, uh, large organization, a global organization, global incorporation. Everyone has three vital parts of financial statements. One is the income statement, the other is the balance sheet, and then comes the cash flow statements. So capital expenditure actually form a part of my cash flow statement. So the capex is basically the money that the company has invested in acquiring, maintaining, or improving the fixed assets. Like for example, there was a very important machinery. A part of that machinery has been changed. With the help of that part, now a part of the machinery was changed, but with the help of that part, now you are able to actually produce more units of your produce that you have. You're able to produce more, you are actually able to service more. Maybe it must be a service machinery or something. So it has actually increased the capacity of your machinery. So capex is that kind of an expenditure, that is the capital expenditure. So that actually forms the part of my cash flow statement. So cash flow from my there are operating activities, financing activities, and investing activities. So from the financing activities, this is the cash flow statement. These are the basic impacts onto my financial statements of the fixed assets. Now moving on to the revaluation. Now we have seen the depreciation stage, the acquiring stage, and the capex stage also. That is, you can take it into the acquisition and the depreciation. Now when it comes to the revaluation stage, when the asset comes to the revaluation stage, so fixed assets revaluation, again, let me just cover it. Fixed assets revaluation is actually a stage where either the value of your fixed asset is increasing or decreasing. So that means that whatever the value that you have of your fixed assets as per your books, it is either going to decrease or either going to increase, and not by depreciation or anything, due to the revaluation. The valuation of the value of your asset is either going to decrease or increase into the markets. So if I put it revaluation in manner, revaluation, the simplest manner is, if I go out and purchase a machinery of the same set, of the same description, of the same manner into the market, what is the value that I'll have to pay to purchase that particular machinery with the same set of uh, things that my current machinery I have into the application. So that is actually fixed assets revaluation. IFRS has stated that initially the fixed asset should be recorded at cost, and subsequently it has allowed you two models to record the fixed assets. One is the cost model, where you record it at the cost, and the other is the revaluation model. Now revaluation model means my my cost has either increased or decreased. That is the current cost into the books. Current cost is basically the cost of the asset minus the accumulated depreciation. So that is the cost that I have into my balance sheet. It is either going to increase or decrease based on the research that is done into the markets. So that is the revaluation model. So this is what is IFRS 16 has. So IFRS has actually allowed. There are two models: cost model and revaluation model. Now let's say I've had a gain on revaluation. So that means if the same set of machinery I go out and purchase in today's current market, I am having a gain in that. I mean, I'll have to pay an amount more than what I have into my books. So that gain I will record into other comprehensive income for that period in which I'm going to revalue my asset. Let's say I have faced a loss on revaluation. Then that loss is going to become a part of the income statement for that period, in which period I have actually revalued the fixed assets. So this is how revaluation has also actually is going to affect my income, the financial statements of my organization. Now let's take a small look on the depreciation of the asset. I mean, what is the depreciation? How is it charged, and how do we actually calculate it? So depreciation is an accounting method of you when you allocate the cost. Just a moment. So depreciation is sorry for that. Depreciation is an accounting method where you allocate the cost of your tangible or the physical asset over its useful life. So again, let us take an example that I've had in IT equipment. Now the IT equipment has a useful life of 9 years. So depreciation is basically when I'm going to allocate the amount of my IT equipment. Let's say the account for the IT equipment was $9 lakh. So I'm going to actually allocate it as in its useful life of 9 years. So this is what depreciation is. Depreciation is the transfer of the portion of the asset's cost from the balance sheet to the income statement during each year of the asset's life. So this part of the whole depreciation asset is basically when I have when I am actually calculating it, and this is the main part which actually helps me into providing the asset cost, I mean the costing into balance sheet and the income statement. So that means in very simpler words, for the purpose of accounting, for the purpose of calculation and for the purpose of accounting is when I am transferring a part of the asset, because the first where the asset is recorded is the balance sheet. I purchase the asset, it becomes the part of my balance sheet. So every year I am transferring a small part of the asset, let's say 10%, 20%, depending on what is the depreciation method that I have used. That a portion of my asset cost from the balance sheet is transferred to the income statement, and this is how my asset into my balance sheet gets depreciated, and at some point of time it diminishes, it ends. There is the value of the asset into my balance sheet is zero. So this is how the depreciation into the accounting language is calculated. The reason why a depreciation is calculated, the reason for the depreciating the fixed assets is basically the matching principle of the accounting. The matching principle of the accounting is where you match the revenue with the expenses. So that means when you have incurred the revenue, you're going to uh, record the expenses also. So this is what the matching principles actually implies. Depreciation is based on the matching principle, that is the depreciation is charged on the fixed assets. So this was we have seen with the this is what we have actually seen the basics of my fixed assets. We know the depreciation, we have the revaluation, and how these parts actually impact the uh, how these parts actually impact my financial statements. So now we have seen this, we are done with my part of the understanding part. So we have done with the concepts. So again, who all were into the yesterday's session and who are new today, this is the checklist of what all things that we'll be taking up into today's session. Now we have done with the basic concepts of my uh, fixed assets, that is what are the basic concepts of my fixed asset depreciation, what is the asset, what are fixed assets, how they are charged, why is depreciation charged, and we've seen what is the impact is on the balance sheet, on the cash flow statement, and what are the impacts on the P&L statements along with the revaluation. Now the next parts are basically considered with my NetSuite application. So moving on to my NetSuite application. So this is the NetSuite application, and this will be taking up the 3 or 4 things that we took up into the NetSuite fixed assets were creating a depreciation method, alternate depreciation method, asset types. These are the things that we'll be taking up, and we'll be just doing it into the NetSuite application, and we'll see how do we do that into the NetSuite application. So the first thing is we'll be creating a new depreciation method. So how do we create a depreciation method into the NetSuite application? Then we'll be taking up how to create an asset. Now creating a depreciation, I'm taking it before creating an asset is because first when you create the depreciation method, you have to then attach the depreciation method with the asset type when you are creating it. So into the NetSuite application, you create the depreciation method. The depreciation method is created. Then you attach it with the fixed asset. Let's say a new fixed asset has been introduced. When you're creating a new asset record, you attach the depreciation to it. So it is better that you create the depreciation method first, and then we create the asset into the application. Now, in order to create a new depreciation method, I'll go to the setup. There are depreciation methods already there, and we can also create a new one also. So as you can see over here, these are the FAM depreciation method lists that we have. That means these are the depreciation methods that that are existing into the NetSuite application. So let's see any one of those over here. Let's view the 20% declining balance method depreciation that is already created over here. So this is the 20% declining balance method that is already created over here, uh, where you will have to write the depreciation formula. You have to specify the period, depreciation method description, formula representation, all that things you'll have to provide at the time of creating the depreciation method. Let us create a depreciation method over here. So we let's say now the depreciation method creation is basically it depends on the organization, the country, the gap system that you're using, the statutory authorities governing you. All of these actually provide you with the depreciation method that you're going to use. Now there are various depreciation methods that are used into the organization. You can have straight line depreciation method, you can have declining balance, double declining balance, sum of years digit. There are various methods of depreciation, on an average 5 methods, unit of production. So all these you can actually introduce into your uh, NetSuite applications. Whichever method that you're going to use, you introduce it into the application. Now let's say I would like to create a new one. I'm not going to save this, I'm just creating it for the purpose of a demo. uh, uh, this is actually, let's say I would like to have 15%, sorry. So this is the 15% depreciation method. uh, this is the declining balance method I am introducing. The depreciation period is I would like to have an annual period of depreciation. That means I would like this depreciation to annually depreciate the assets of the organization. Now this is the end period number, and the next depreciation method is actually implies when, let's say sometimes it happens is that I would like that in the first year of depreciation, that is into the first year of depreciation, I would like 15% depreciation method to depreciate the asset. Now after first year, for the next remaining life of the asset. It can be 3 years, 4 years, depending on the asset on which this method is applicable. On the next 5 years, 4 years, whatever is the remaining life, I would like it to depreciate the asset at 10% depreciation method. So here the end number period is 1, because I'm using it here 1 because I have actually provided the period annually. So I want that after the first year, this particular method, whichever is applicable to any asset, it starts depreciating at 10% declining balance and not 15%. Had I used monthly over year, the end period number would be 12. So that means after 12 depreciation periods, it should start depreciating at 10% declining balance. But here I have selected annually, so I am only selecting 1. So that means after 1 depreciation when has been charged, it should start depreciating at 10% declining balance for the remaining life of the asset. Now here we'll have to record the depreciation formula. Now the depreciation formula for the declining balance is your book value minus the residual value into whatever the percentage by the asset life. Now here you have your common NB is net book value, RV is residual value, AL is asset life. So you have your jargons here. You can actually just use them and provide for your depreciation formula. So for the 15% demo depreciation, I'm using the formula which we usually use into the while calculating the depreciation. So this is the formula that I have put up, for which I would like 15% depreciation method to be used. And the final period convention is whether you would like to fully depreciate the asset or you would like certain balance to remain into the that particular depreciation method. So I would like the depreciation to, I mean, I would like this particular depreciation method to fully depreciate the asset in whichever asset this has been attached. I would like this to fully depreciate it. Usually every organization use the fully depreciation. The retained balance is usually used into the methods where you have certain project, the asset has been used specifically for the project or something, then you use this. Otherwise you have a fully depreciation period convention. So this is how you actually will create a depreciation method into the NetSuite application. But I do not want to save it, so I'm not saving it. This is for the demo purpose. Let me just save it and then we'll delete it. So I'm going to just save it. Uh, just a moment. Yes. So as we can see, this internal ID 143, this is the depreciation method that we have just created, and it has saved the value, that is demo depreciation 15% demo depreciation method. I have actually introduced into the application. This is how you can actually introduce the depreciation method into the application. Now we've seen how do you create a depreciation method into the NetSuite application. Moving back to our checklist. So we have done with this. The next part is alternate methods of tax depreciation. Alternate methods of tax depreciation is basically what happens into most of the countries is that what you do is you have different depreciation schedules. You use one depreciation schedule for the purpose of accounting. The other depreciation schedule is used for the taxation authorities. Mostly it is taxation authorities, or if any other statutory authority by which you are governed by, if you're a public company or if you're a public organization, then there are uh, other methods also. Just a moment, please. I'm so sorry for this. Yes, so we were on the alternate methods of depreciation. Now, what happens in the alternate methods of depreciation is you use a depreciation schedule one for the accounting method, the other one is for your tax authorities. Now, what happens is most of the countries, like in India, it happens is you have a depreciation schedule. There might be an asset which you are actually depreciating in SLM method for your accounting purpose. But the taxation authorities require that you depreciate the asset at 10% declining balance. It may also happen that as per your organization, uh, asset might have a useful value of 10 years, but the taxation authorities or any other statutory authority will have specified that useful asset for, yeah, the useful life for any particular asset, let's take IT equipments, is only 7 years, but as per you the useful asset life is 10 years. So that means as per you the asset is going to diminish in 10 years, but as per the authorities the asset is going to diminish as per in the next 7 years only from the time of its uh, purchasing. So this is why what you can do, and this is what happens in most of the countries. So what happens is, what you can do is, whenever you create an asset, or you create a record into your asset, what you do is you select your accounting method for the purpose of depreciation, and along with that, into the NetSuite application you can attach an alternate method for the purpose of maybe tax calculation, for the taxation depreciation, for any other statutory authorities depreciation requirements. Now we can, let's also go and see the alternate methods of tax depreciation. Sorry, alternate methods of fixed assets depreciation. Now as you can see, these are certain existing methods of alternate methods. As you can see over here, there are 10 alternate methods of depreciation over here, like now here the name given is depreciation method 1, 2, 3. It depends on your organization or for the client for which you are implementing this. They, you can actually use a different alternate method one, alternate method for this particular asset, or any other kind of name that you can actually, that you want to use into the alternate methods. Now these are the existing methods. As you can see, the alternate method that have been created is 150 declining balance, 10% declining balance, 200 declining. These are the that have been created. You can of course create a new method also. So as you can see, this is the form for creating a new alternate method of depreciation. Where since this has been going on, so I'm going to give it a name for demo depreciation. So this is just a name I have given. You can provide any other name also depending on your choices. This is just for the demo, so I am providing a demo depreciation, so it is easier for me to if I want to just delete it. Now the depreciation methods that you have created, that we have just created, I can choose any one from those, because of course the method that are there into the application, only that you will be able to choose. Let's say I would like to have the same demo 15% depreciation. This is the depreciation method that I would like to choose on alternate method. Also, let's say you've opened this particular form and you forgot to create the depreciation method. You can create the depreciation method, a new depreciation method, directly from here. So you do not have to go back and create a depreciation method. When you click on this new, the form that we've just seen, that is creating an depreciation method, is going to open up, fill in the details, and you can just create that depreciation method from here also. You do not have to close this and go back. Now the convention, the averaging convention that will be used to, you specify here, is the averaging convention that will be used to determine the treatment of depreciation during the first year of the asset's depreciation. The averaging convention is specifically for the alternate method. Now, this is usually selected is none, but if you want, you can select half year, mid quarter, mid month. So that means, let's say I have selected it mid month, so the convention will be the monthly depreciation. If I have actually selected mid quarter, it is going to start from the mid quarter, irrespective of the date from which I have started using the asset. Let's say I have started using the asset, then the quarter is going to end on September. So the mid quarter will start from 15th of August, let's say. I started using the asset from 10th of August or 5th of August. So irrespective of the usage of the asset, it is going to start calculating the depreciation from 15th of August only. So this is what the convention over here is. I'm specifying it as no. The asset life. Now, whenever you are creating an alternate method, as I had informed you, usually the authorities provide you with the useful life along with the depreciation method. Most of the places, at most of the countries, when any statutory authority provides you that for this particular asset having this specification, if you are purchasing it, you're using it for your business, what you do is you charge it with this particular depreciation method, and the useful life for that asset is this. So let's say the depreciation, for the depreciation method, that is 15% depreciation method, that was required by me, by the authorities, is 7 years. So for the asset for which I am creating this alternate method, the statutory authorities or the tax authority has provided me that the useful life for that particular asset is 7 years. So I'm going to specify that this is the 7-year life of the asset that I have. Now the financial year start, it depends. Let's say I'm creating this depreciation method for my Indian subsidiary, so this financial year start will be April. And the subsidiary for which I am specifying is the Indian subsidiary. Any Indian subsidiary that you would like to have. Okay, so there has been an issue, and there the Indian subsidiary I'm unable to find. Yes. So let's say I would like to use it for a subsidiary. This is the subsidiary for which I would like to use it. Then comes is the pool flag and the override flag. When you check the pool flag box, then this method of depreciation is actually applied into a group of assets. So pool flag is when you are going to attach this depreciation method to the group of asset. Then the override flag. Now this one is an important one, which is preferred to be used, but if you want your uh, suggestions and your asset types and everything to be very rigid, and you do not want any changes to be made, you can click this. Now what happens with the override flag is, uh, when you're attaching the alternate method with the asset type, it still gives you the if you have checked the override flag, uh, it still gives you a room for editing. Let's say at the time of attaching, I can edit the financial year start, I can edit the asset life, I can edit the convention. So I can edit these informations. But if the override flag is not checked, so I'll not be able to change or edit any of these information when I'm attaching it with the asset. So when I'm attaching it with the asset, as it has been specified here, that is 7 years of lifetime, convention none. For this subsidiary, the financial is start year is January, the period convention is 12 months of 30 days each. So this is the only information that I'll be able to use. I'll not be able to override it, or I'll not be able to change the asset life. Let's say I would like to change the all the information for this alternate method is same, but the asset life that is used for, I am attaching it with any other. I've created this for an IT equipment, but let's say every information is same, only there is a change into the asset life from 7 to 9 years. So what I can do is, I do not have to create a new method with the asset life of 9 years. I've checked the override flag, I attached this to an asset, and when I'm attaching it, I can specify the asset life into 9 years, from 7 to 9 years. So here I would like that at the time of attaching, I might require to change certain information, so I am clicking the override flag. And then comes is the period convention. That means 12 months of 30 days each. So you will get, when you click this, you have in the 12 months of 30-day each, you have an uh, equal depreciation. That is, you have homogeneous depreciation across all the months. And if you choose exact number of days in months, then certain months have 30 days, certain one has 28, certain have 31. So you're going to get different depreciation amounts. Difference might be of $1, $2, $10, $20, but the depreciation amount, the depreciation expense will be different for each month. So it is recommended that we use the 12 months of 30-day each, so that we have the same depreciation across the months if you're choosing it in monthly depreciation. So this is a depreciation method that I have actually created, and I would like to now save it. Okay, so let's say we have saved it. So as you can see, this is the depreciation method that has been created. So now we have created a depreciation method. We've created an alternate depreciation method. Let me just create a new asset record also. This is the new asset record form that we have into our NetSuite application. Now, as you can see, every amount over here, or every uh, block here is very self-explanatory, where you have to provide a asset name over here, the description of the asset. Let's say I've brought a new asset, asset serial number, if there is any serial number attached to that asset. Let's say I've purchased a machinery, land, then it might have certain uh, number that is allotted to a land. Every land piece of land has a specific number attached to it, depending on from where you have purchased and where you have purchased it. I've purchased a machinery, so every machinery has a unique machinery number also. So if any asset serial number is there, you can attach it. Alternate asset number, one is that is automatically the ID is generated by the NetSuite application. You can of course have your own ID also, and any alternate asset number like hashtag 12, any kind of alternate asset number that you would like to give, you can provide here. Now this asset is a child of asset. Let's say this is a child of any of the asset existing into the like I've got BISP land 234. So this particular asset might be the child of this asset. So all those specifications of BISP land will actually apply to this particular asset. If it is a child of an asset, but it is an individual asset, you do not have to select the child. You can select the job from here. Then the next important information is the asset type. You have to specify the asset type. What is it? Now, what are asset types? You'll be looking at that also. Asset types is basically a broader list of all the, you have segregated the asset. The assets are segregated into IT equipment assets. You've got property, plant, and equipments, research equipments, leasehold improvements, furnitures and fixtures. Now, furniture and fixture is a big group. Into the group comes chairs, tables, or any kind of furniture into your organizations, any furniture set that you have purchased. So that will form a part of that group. So asset types is basically the group of assets that you have in your organizations. Then is the original cost of the asset. That is the cost at which you have bought the asset. If let's say you are introducing an existing asset into the NetSuite application, Then you provide with the original cost, the cost at which you bought the asset, and then you have the current cost of the asset if it is an existing asset. Then you might have the residual value percentage, residual value, salvage value, which we use in the normal day life, that the term that we use is salvage value. Then you attach the depreciation method with this. Let's say I'm attaching this particular depreciation method that we've just created. So you can create any of you can add any of the depreciation method. Now this depreciation method is the accounting depreciation method, but of course you can choose the alternate method, or you can choose the taxation authority depreciation method, and into the other method, alternate method, you can choose the accounting schedule. Asset lifetime, the lifetime of the asset. Depreciation period, whether you want the depreciation to be charged annually or monthly. uh, Current net book value, lifetime usage. This is when you are introducing an existing asset. So current net book value, let's say there is an asset which was purchased 3 years ago. The useful life is 7 years. So after 3 years of charging the depreciation, the net book value that is remaining into your uh, organization, to your books of accounts, you provide it over here. The cumulative depreciation is automatically calculated by that. Asset status, whether it is a new asset, depreciating, that is existing asset, fully depreciated asset. You've actually introduced an asset that is fully depreciated, but you have, since you doing an implementation of the NetSuite, so you might be having certain assets which have been fully depreciated, but of course you want them to become a part of your NetSuite application. Then there are you can also create disposed of assets, that there was an asset that has been disposed of, but still it is a part of your organization, and you want to it to become a part of your NetSuite application also. So whenever, if an auditor or someone views the NetSuite application, they'll be able to view it. Splitting, partially disposed or depreciated, a partially disposed asset, part of which has been disposed, part is in use. So you can specify the status of the asset. And then you have your customer location, any information if you would like to put it. Now into the general tab, notes and files are not. Into the general tab, you can specify more about the asset, the department in which it is used, the class, location, subsidiary, custodian, where is it located, from where have you purchased it, the supplier, the order number, depreciation start date. The end date is automatically calculated by the asset life that you've provided. If it is an existing asset, so what is the last depreciation period? Now depreciation period in months will be, for 3 years will be 36 depreciation method period. If it was annually depreciation, the last depreciation period will be 3. Last depreciation amount, what was the last depreciation amount? So that means if it was monthly, the whatever is the depreciation amount. If it was annually, what is the depreciation amount? Last depreciation date, you can select from here what was the last depreciation date. Like if it is annually, you can select 31st of December 2019. If it is monthly, you can select 31st of August 2020. Last target depreciation date, depreciation active, rules for depreciation. Now rules for depreciation is, if it is a new asset, how do you want to depreciate it? You want to depreciate it from the acquisition date, for the disposal period, from mid month, or pro rata basis. That is how you use it, depending on that basis. Then revision rules. Revision rules is basically for your revaluation. So how do you want the revaluation to take place? In the current, if you check on the current period, depreciation to date is recalculated in case of revaluation, and the difference is posted into the current period P&L, whatever is the increase or decrease. And if you choose remaining life, so then the revision applies to from the point forward. So this is prospective and this is retrospective. So how do you want the revaluation to take place? Prospectively or retrospectively? Usually it is prospectively, but it of course depends on the organization choices and preferences, IFRS rules, gap rules, local gap, multi gap rules that you have. And all of this information you can provide. Now here is the important part, is the account. Now what is the asset account? Now this is asset account, depreciation charge account, write-off account. All this information is when you are creating your account into the chart of accounts. From here you can choose the fixed assets management. Like here, since we are done with this, let me just we'll take up the accounts part, so that we'll move it into the chart of accounts. I'm leaving the accounts part as of here. So in case if it is a leased asset, you can provide all the information about the lease, whether it is if it is a finance lease, what is the cost of lease, what is the rental amount, rental frequencies, interest rate, start date, end date, contract number, the company, first payment due date, last payment due date. All that information you can actually just put over into the asset. If the asset is insured, all the insurance information you can also put it. You have given an AMC contract to one of the companies, you can put that information also over here. A sale and disposal is in it is okay if you do not want to put it. A set sale and disposal, all the information will be taken up. Now when I come to this account, we're done with all the information that can become a part of the asset when you're creating an asset. Now into the chart of accounts, when you create a new account, as you see here show in fixed assets management, you can create an asset account which you choose into the asset account, depreciation expense account, write off account, write down account, disposal cost accounts. That is, the asset account can be the IT laptop account, depreciation account is laptop depreciation account, accumulated laptop depreciation account, depreciation expenses, laptop depreciation expense, write off sale or loss of the laptop on the laptop asset account, write down account also you can actually create. And this is how you specify those, and these will be available into the drop down list which you have into the account sub tab of the FAM asset, that is fixed assets management asset. So we are done with the asset creation also. That is, we are done with the alternate methods, and then we have seen the asset types. Now you can also actually import CSV records into the uh, assets. With the that means into the CSV file is uh, as you can see, this is the CSV file that you can use to import the existing assets. Like here we have seen how can you manually create it. Let's say I've got 1000 assets into my company, into my client's company, and I would like to actually just uh, introduce it into the NetSuite application. So instead of creating uh, 1000 assets into the application, what you can do is you can have this type of CSV record file, and you can import it into the NetSuite application. Now how you can do it into the NetSuite application is into the setup, import export, importing the CSV records. Here you can select custom records. You can select the record type as FAM asset, this one. Character encoding, whether it is a comma delimited, semi-comma delimited, whatever delimited file that you're using. Select the file and you can import it into the application. You can select the file. So this is the file that we have. You can select it and you can import it. How do you want to, whether you want to add the information, update the existing assets information, add or update, depending on whatever is the choices. You can select next, and then you have your required fields, and just a moment. Yes, so you can have your required, as you now have the required fields over here, you can map it and you can import it. So here I am, unfortunately I'm not mapping, I'm just you have the mapping fields over here. I do not have, I'm not importing it as of now. So this is how you can actually import your CSV files to the NetSuite application. into existing records of your just a moment, of your existing records into the NetSuite application. This is how you can actually just do that. Moving back to our checklist. Yes, so these were all the things, small things, or important parts of the fixed assets management that we have covered into our NetSuite application for today. And yes, so in case of any uh, queries or consultations, if you have any queries or any questions, any doubts that you have, you can put up into the chat boxes. Okay, thank you so much. Okay, so thank you. I suppose we are done with the session. We have taken up everything. So thank you everyone for attending. Thank you. Have a good day.